Remember we said that accounting for equity investments depends on the level of influence or the percentage of ownership held by the investor. The investor holds about 20% to about 50% of the investee's common stock. We use the equity method. This video covers the equity method. As always, the investment is always recorded at cost. But then after the investment is first recorded, that's where the accounting treatment differs entirely from the fair value method. From a balance sheet perspective, the investment account, that's what we're going to focus on. And the investment account is increased by the investor's percentage share of the investee's net income. Or if the investee has a net loss, it will be reduced by a net loss. So what we're saying is, rather than recording increases in fair value, what changes the asset investment account is when the investee reports its net income. The investor has such significant influence over the investee. It says some of that net income is mine. If I own a 40% interest in the investee, 40% of that net income is going to be recorded as an increase to my investment account. The investment account is decreased by the investor's share of the investee's dividends. So when the investee records dividends and pays dividends to the investor, this is going to decrease the investor's investment account. Now, why would that be? Let's say I have a 40% equity stake in a company. And when that company pays me dividends, my asset investment in equity securities is actually going to decrease. Why would that be? Well, remember what retained earnings is. The value of retained earnings, and remember that this is a stockholder's equity account, right? The value of that company starts with whatever they had the last period. It increases by net income, and that's what we have here, and it decreases by the amount of dividends, and that gives you your ending retained earnings. So what we're saying is, if you have this equity stake in the company, you own so much of their equity that when you're getting the dividends, it's reducing your equity account. Okay, and then finally, I'm going to use this very broad bullet point, adjust for other items, and we'll get to that later. Let's start on our example. Record each of the following transactions for T-Pain Company. T-Pain Corporation. TPC purchases 30% of the common stock of Bruce Springsteen Corporation on January 2nd, 2024. The fair value of the company was $5 million at the time of the purchase. All right, so let's record that entry. We acquire the asset at cost. So this is on January 2nd. The company receives the investment. We're going to call it investment in equity affiliate, to show that we own so much that it's not just an equity investment, it is an affiliate. We purchase it for $1.5 million, which is equal to, it's the fair value of the company is $5 million, the investee, and we buy 30% of that. So it's worth $1.5 million, And of course, we pay out cash for our investment. What happens here? This investment equity affiliate, of course, is an asset account, so assets go up, but the asset cash goes down. Time passes towards the end of the year on December 28th. The investee, BSC, pays a total of $250,000 of cash to all of its stockholders. So TPC, the investor, the buyer of, or the holder of this investment, is going to receive, they have a 30% interest in the investee, they're going to get 30% of the dividends. So we're going to take the 250,000 times 30%. The amount of the dividends is 75,000. Okay, so the holder of the investment, the investor, is going to receive cash, 75,000. And then remember what we said about dividends. No dividend revenue is going to be recorded. This is different from the fair value through net income method. It's easy to get confused about this. So this is an important note. What we do is we reduce the value of the asset investment in equity affiliate. Same way that when a company issues dividends, they decrease retained earnings. They decrease the value of the investor's claim to the company. Now we're saying we own so much, the value of our investment decreases. Okay, so cash goes up, so assets increase one side, and on the other side, assets decrease. Three, on December 31st, BSC reports net income of $500,000. Okay, so what do we know about when using the equity method? When our investee reports net income, that our percentage of that is going to increase the investment in equity affiliate, that asset account. This is going to increase the net income for all of the entire company is $500,000. We are entitled to 30% of that, so we increase the asset account by $150,000. And the other side of this entry, I didn't cover that before, we are going to record to the income statement account investment revenue. Okay, so this debit to investment equity affiliate increases our assets, and the investment revenue increases net income. One bullet point I want to make is that using the equity method, we do not use, this is an income statement account, do not use for that income statement gain on investments. We use that when we're doing the fair value through net income method. We're going to use investment revenue instead on the income statement. 4, when TPC purchased the investment, the fair value of that company's net assets simply means assets minus liabilities. When you buy another company, you get all of their assets, but you also have to take on all of their liabilities. So assets minus liabilities was equal to $3.6 million. That's the fair value. That's what, if each one of these assets was sold out in the marketplace and you take on the liability, 3.6, but on the books of this investee company, the assets were 2.1 million. What would cause the difference between book value and fair value? We'll think about inventory. If there's inflation, the inventory that was purchased previously might have increased in value if it had to have been purchased today. The buildings, the equipment that had been purchased and then depreciated, well, it's possible those buildings have actually appreciated over time, and that's not going to be captured on the balance sheet. The 1.5 million difference is due to, here we have buildings and land both being undervalued. Okay, market prices have gone up. Buildings have a fair value greater than the book value of $1 million, and land has a fair value greater than the book value of $500,000. The buildings are estimated to have a remaining life. Okay, so what's going on here? Well, let's assume that TPC purchased the entire company, all of BSC. We would then, TPC would have to record an investment that's worth $3.6 million, right? When we buy another company, we record all of their assets and liabilities at fair value, not at the acquired company's book value. And if we had done that, the equipment, the buildings and equipment, would be worth $1 million more than what we purchased at. And what would happen then? What would we have to do at the end of each year? We'd have to depreciate. We'd take this $1 million, that is the real amount of the buildings, and we would have to depreciate. We'd have a future expense. This 1 million represents future expense through depreciation over time, over the 10 years. Now, we only bought 30%, so we are going to have to record an adjustment for that future expense. We're not going to call it depreciation, but that's what it relates to. We don't have to worry about the $500,000 increase above book value for the land because land is not depreciated. There's no future expense related to an increase in value in land. All right, so let's write some notes and then let's record this related to 4. So if TPC purchased 30% of BSC's buildings, it would record them at fair value. We don't know exactly what that fair value is, but we know that the additional amount above fair value is 1 million, and we would depreciate the fair value over the future, over the estimated useful life of the buildings. Land is not depreciated. The adjustment necessary, or the adjustment that we're going to record, we're not going to record depreciation on this investment because we don't own the building, so there really is nothing to depreciate. We're going to say our investment is going to decline in value, and we're going to know it's because of that hidden depreciation. So the adjustment related to the additional depreciation expense that our investment is recording, or they're not recording, but they would, if we recorded our buildings at fair value, the investee would record additional depreciation. The adjustment related to the additional depreciation expense is recorded as a reduction to the asset investment account. Okay, remember this is an asset account. We reduce our investment, and also a reduction to an income statement account called investment revenue. Okay, so let's record that journal entry. We are going to decrease investment revenue. which is going to decrease net income. We're going to decrease the asset investment in equity affiliate. And then we need to determine the dollar amount. Some amount here. And to determine this, I'm going to take the amount that fair value exceeds book value. So this is our journal entry up here. This is my calculation of the dollar amount. Fair value exceeds book value by 1 million. Multiply that by the percentage ownership. So our portion that fair value exceeds book value is $300,000. That is future depreciation. We're not going to record depreciation. We don't own the buildings. But we are going to take this $300,000 and allocate it over the 10-year useful life. And we're going to recognize a decrease in investment revenue and a decrease in the asset value of $30,000 every year for 10 years. First, this is going to decrease net income, and this is going to decrease total assets. The last item says what amounts would be reported on the 2024 income statement and on the 12/31/24 balance sheet. The 2024 income statement reports, so nothing on the income statement here, nothing for the income statement on December 28th. December 31st, we have investment income of $150,000, and then for our last adjustment at the end of the year, we reduce investment income by $30,000. So we have a net investment revenue of $120,000. And the 12/31/24 balance sheet is going to report the investment in equity affiliate on the asset side of the balance sheet. And what is the balance in that? Okay, so we start with 1.5 million on January 2nd. We decrease it by 75,000 on January 28th. We increase it by 150,000 on December 31st. And then this entry is also recorded on December 31st. And we decrease it by 30,000. So let's just show what that's where the number comes from. 1.5 million cost minus 75,000 dividends plus 150,000 our portion of the revenue of the net income, and that other adjustment decreased 30,000. This works out to be a total amount of $1,545,000.